Is Michael Burry right this time? Tuesday, the S&P closed at record high, $3.7 trillion added in 4 sessions. Same day, Michael Burry said he still sees a possible 1987 type fall and he is not covering his shorts. Every channel is now arguing about whether stocks are expensive. That's not what he said. His argument is about plumbing, and plumbing you can check. Here is the claim. Equities rise, realized volatility drops. Volume targeting funds mechanically add leverage, not because they have a view, because their rules say so. Momentum funds chase the same winners, prices rise, volume falls further, and note the escape hatch. He says the market goes up first, so the market going up doesn't disprove him. So, let's check it. One formula. Weight equals target volatility divided by forecast volatility. 10 million at a 12% target. If volume is 8, you are holding 15 million leveraged. If volume spikes to 24, you are at 5 million sitting on cash. Roughly 1 to 400 billion runs this way, capped at 1.5 to 2 times. Now, the number nobody has bothered to run. 20-day realized volatility on S&P is 14.1%. Put it through the formula. 10% target 0.71, 12% 0.85, 15% 1.06. All at or below 1 times. These funds are holding cash. They are not leveraged. To get the leverage we saw in 2017 and 2023, volume has to fall to 8 or 9. It's all 14. The loop is real. It just isn't loaded. The other story is that call buying fueled this. 0-day options, 48% of retail volume, 20 million contracts a day. Huge and directionally irrelevant. Chicago Board of Exchange owns data puts net dealer gamma under 700 million against 400 billion in daily futures liquidity. Volume is not race. Does the 87 comparison hold? Partially. The mechanism that was portfolio insurance, computers selling at prices fell. Same shape, fair. Here is what's not fair. Portfolio insurance had no leverage cap, today's cap at 2 times. No circuit breakers existed then. Today, a 22% fall punches through 3 mandated halts. And the big one, the market was already down 12% before Black Monday. 87 was the end of a decline, not a bolt from a record high. Now, the other side, honestly, Q2 earnings growth came in at 47%, but that's flattered by a $98 billion one-off at Alphabet. Strip it out, 28.8 7th straight double-digit quarter. Buybacks 665 billion in 4 months, biggest start on record. That's a real bid under this market. And the awkward part for these bears, first half AMD was 70, Micron 45, Intel 13, Nvidia 5. Capital rotated to the largest. Nvidia now nears 22 times forward, a decade low. Burry's biggest closing position is a short on the cheapest large AI name. It gets worse. He holds Palantir puts at 150 plus a direct short. On August 4th, Palantir rose 29.5%. His largest short had one of its worst days. The same day he published the warning. Now, the part nobody is telling you. Burry deregistered his Sion capital in November 2025. That ended his 13th F filings. Last audited disclosure, Q3 2025, Everything since is a voluntary post on a paid newsletter. I'm not accusing him of anything, but every position size quoted his week is self reported and unauditable. That's a change in the standard of evidence. Two hits subprime in 2008, early 2020. Then 2015, imminent crash, S&P up 11, 2017, global meltdown up 19, 2019, ETF bubble, nothing, 2020, three sell signal, market rallied. One reviewer scores him near 29% since the crisis. Treat that as one analyst's count. The honest read. He is a brilliant security analyst. He is not a macro timer. Different jobs. Seasonality does back him slightly. August and September are the only back-to-back pair averaging negative since 45. But September 2025 gained 3.5%, tendency not rule. The mechanism is liquidity. Thin participation gaps more easily. The risk isn't the average, it's the fragility. So, how would you know? 4 steps in order. 1. Volume compresses below 9. It's at 14. 2. Breadth narrows. Right now, advancers beat decliners 3-1. 3rd. An ignition shock. Fed hike, hormone collapse, AI capex guide down. 4th. Leverage releases into an exhausted bid. Steps 1 and 2 aren't there. It's a sequence, not a level. So, calendar. August 26th. Nvidia earnings and the PCE print same day. August 27. Jackson Hole post under share wars. September. FOMC futures price a hike. Economists forecast cuts. December. His Palantir puts expire. A hard-dated test. So, where does that leave us? The mechanism is real and it's not loaded. High confidence. The 87 analogy is misapplied. High confidence. Timing low. His framing is built so it can't be falsified. His actual positions unknowable. I won't pretend otherwise. One thing to take away. Watch 20-day realized volume on the S&P 5. It's at 14.1. The number that matters is 8 to 9 until it gets there. The machinery for the systematic break isn't funded. I will be watching. See you the next week. Thank you.